Welcome to the first chapter 9 video in engineering economics. And this video and this chapter is about depreciation. A couple things to note here before we get started. This chapter is the first chapter in Unit 3, and the difference between Unit 3 and our previous two units is that Unit 3 is really more about accounting. So in the previous units, we have looked at things that are basically controlled by mathematics. In other words, if we invested $100 at 5%, we would have $105. That's true no matter what. That's just a mathematical truth. But the thing about accounting is that it's affected by laws and government regulations. So I want to make a few disclaimers before we get started here. This class is not going to teach you to be an accountant. We're not going to learn the tax code in and out. We're just going to learn some basic accounting principles. So this is just sort of a summary or simplified approach to some basic accounting principles. And the first principle we are going to talk about is depreciation. So you may already be familiar with the word depreciation. It's commonly used in day-to-day language to describe the way something loses its value over time. I think it's probably most associated with owning a vehicle. If you go out and you buy a new car and you drive it off the lot, it suddenly becomes a used car and will continue to lose value over the time that you lose it. And so that's very similar to the type of accounting depreciation we're going to be talking about. We are going to talk about the book value of an asset and what it's worth. But when we're talking about depreciation in this class, we're really talking about an accounting, I don't want to say trick. It's not a trick. These things are all allowed and legal, but it's just one of the things that accountants do. They basically take a cost. So if you go out and you buy a piece of equipment for your engineering company, even if you pay for it in cash up front, the accountant will take that cost, and rather than putting it on the balance sheet as being all at one time, they'll spread it out over a certain number of years. So according to your financial records, it looks as though you paid a little bit towards that asset over time. And there are some benefits to doing that, mainly tax benefits. So it's basically just a way of recording your expenses. How do you distribute the cost of an asset over time? So the term here that's used for these assets is capitalization. We are capitalizing the asset by distributing that cost over a number of periods. And there are several different methods by which you can do this, and we're going to talk about a few of them. So the first thing you need to establish whenever you're going to depreciate an asset is what is the cost of the asset? What is its true value, which may or may not always be equal to the sticker price, so to speak, the money you actually pay for it. There may be other costs involved with this asset, which you can include in its total value. So we need to establish the cost of the asset. We need to also determine what is the depreciable life of the asset. So that you can think of that in terms of just simply how long that asset will be used. Now, if you're just recording the depreciation of an asset for your own balance sheets, you can essentially choose to pick whatever depreciable life makes most sense to you. But for the tax purposes, for reporting to the IRS, there are some guidelines, and we'll take a look at those as far as what the depreciable life of a particular asset should be. We then want to consider what the asset's value will be at the end of its useful life. In other words, will it have a salvage value? Will we be able to sell it for some amount of money, or will we have used up all of its value? And then, as I said earlier, there are different methods of depreciation which we can choose between. So we'd have to choose which one we want to use. So we do also need to point out that there are some things that are not considered depreciable assets. So to be a depreciable asset, it has to be something that gets used up or worn out over time. So things like buildings, machinery, equipment, vehicles, and even intellectual property like copyrights and patents, they can all wear out over time or become obsolete. Um, if you had the copyright to a particular type of VCR, um, I don't even know if you guys listening to this are old enough to remember VCRs, but that technology became obsolete, replaced by CDs and now Blu-rays and streaming services. So VCRs and video cassettes are a thing of the past. The patent being an intellectual property, if you had a patent for one of those types of devices, would not be useful today. It would not have any value. So, although it doesn't physically wear out, the usefulness of it can. And buildings require maintenance and eventually potentially fall into disrepair and may need to be bulldozed or renovated. Machinery wears out over its useful life, same with equipment and vehicles. Now, certainly you can, with proper maintenance, keep them running or operating longer, but we're going to basically talk about average lifespans for this equipment, or a reasonable lifespan. So it almost seems as if everything is a depreciable asset, but that's not necessarily true. There are some things that are not considered depreciable. So if you are in the business of making, I don't know, I'm looking down at my desk here and I see a calculator. So let's say you are a calculator making business. You manufacture calculators and you have a warehouse full of calculators that you are getting ready to distribute to stores for sale. That is your inventory, and that is not something that you can depreciate over time. You're not allowed to take the cost that went into building those calculators and spread them out over time. So inventory, the stuff that you build or create as part of your business plan, is not a depreciable asset. And then the other thing is land. So although certain parts of the land, certain things that are on the land, maybe your parking lot, might depreciate over time because it does get worn out. You get cracks in it, you get potholes, and eventually it needs to be repaired or repaved. The land itself that your buildings and your parking lot and things like that sit on does not depreciate over time. In fact, land has a tendency to appreciate, to go up in value over time. So the actual land itself that your buildings and equipment and other assets are sitting on, that land itself is not depreciable. So when we need to establish the cost of our asset, the term that's used by the book is cost basis. And this is basically just saying what is the total value of the asset that you're going to depreciate. And as I said earlier, this is going to include more than just the sticker price, more than just the value of the asset. It may also include the freight or delivery fees required to get the asset into your possession. Any type of site preparation that has to be done, any type of installation fees. So, if I'm just trying to think of consumer type assets, if I went out and bought a new set of appliances for my kitchen, okay, there's the cost that I might pay to the store for the stove and the refrigerator, but then there also might be a delivery fee. There might be a fee to take away the old equipment. Maybe I've chosen to pay someone to install it for me, and any other cost associated with that delivery, installation, preparation, that can all be included in what we call the cost basis of the asset. So if we look at an example here, a company buys a machine priced at $21,500. The firm had to pay sales tax of $1,200. Transportation charges were $525. The installation cost was $1,350. Site preparation $2,125. What is the cost basis for the new machine for depreciation purposes? So basically, we have the cost of $21,500. So the point I'm trying to make here is that the total cost basis is more than just that value. We also have the tax, the transportation, the installation, and the site prep. Are these things considered part of the cost basis? Well, the cost itself, yes, that's obvious. That's the primary part of the cost basis. But tax, is that also something that can be capitalized? Yes, it is. Transportation cost? Yes. Installation? Yes. And site preparation? Yes. So all of these things go into the cost basis of this piece of machinery. So to find the cost basis, we just add all these dollar values up, and we get a total of $26,700. So that is the value we would assign to this asset. And then we would be able to depreciate that asset, or basically break it up into smaller pieces and spread it out over time. So I think this is probably a good stopping point. We've kind of introduced this idea of depreciation, and we're kind of starting to get into some of the particulars of how we go about doing it. But I'm coming up on fairly close to my 15-minute time limit, and so I think this will be a good time to stop, and we'll resume this discussion in the next video.